As a private lender, part of my job is to identify risk and to minimize the impact of that risk on a potential real estate investment. Every day, I'm looking at commercial and residential investment projects. And what strikes me is that a lot of times the difference between a successful and unsuccessful investor is really their ability to identify potential problems and to have a plan when things don't go their way. Let's take a look at some of the most common pitfalls that people fall into and some ways that you can mitigate those problems and keep your project on track. You might be saying to yourself, Josh, it's great to avoid problems, but I just don't have the money to invest in real estate right now. I understand. Liquidity can be a problem whether you're a first time investor or whether you've got 20 rehabs going on at the moment. At Hard Money Bankers, we help real estate investors who need fast funding from a local private hard money lender that they can trust. HMB is easy, fast, and flexible and can close on your loan as soon as tomorrow. Call me today at 717-213-8488 or check us out online at hardmoneybankers.com. The most common pitfall in a rehab is when an investor doesn't do the math, right? Bad math can often be divided into three separate topics, and we'll go through each one. But let's start with the first, which is unrealistic after repair value. This drives me a little bit crazy. I get people who call me all of the time that are giving me ARVs that just are not supported. And oftentimes it's because they fall in a couple different areas. The success of a value add project, it really hinges on the resale or the appraisal value of that property after the work is complete, right? So nailing that ARV is going to have a big impact on whether or not this project is successful. Investors and entrepreneurs are, typically really great at assessing opportunity or identifying opportunity. But as a result, oftentimes we don't see the flip side of that. So determining the ARV for a property can be kind of difficult. There's no two properties that are going to be exactly the same. No two projects are going to be the same. No two investors are the same. If you and I flip the same house, the likelihood is that we're going to have different finishes. We're going to hire different contractors. We're going to have a different listing agent when we sell the place. And as a result, we're probably going to have two different sales prices. That can be a huge problem if we are not looking at the same data, right? So here's how to fix it. First, use comps that are the same. We're talking about the same types of properties. We want to use ranchers with ranchers. We want to use colonial properties with colonials, split levels with split levels. If you're looking at a detached colonial property, you don't want to look at an attached or, use a townhouse as a comp and vice versa. Second, we want to look at properties that are about the same size, right? So we're looking at the same types of properties, the same size, plus or minus about 10% is going to be about what you're looking for. Third, the same neighborhood. This is a big one. Whether you're in an urban area and you're looking in different subdivisions, or you're not really urban, but suburban, or you're in an urban environment where, a major intersection could be the difference of tens of thousands of dollars, it really matters the location of that property. And the closer we can get to that subject property, the better. And then the same level of finishes. This is a huge deal. And I touched on this in the comparison is that, look, if I'm not planning on upgrading the kitchens and bathrooms and I'm just doing paint and carpet, I can't very well pull out the comps of houses that have new kitchens and new bathrooms and say, my house is going to be worth the same, especially if the property was built in the 1950s and I have original cabinets in there and, we've got the blue and pink tile in the bathrooms. That's a problem. We want to make sure that our construction budget that we'll cover in a minute here, but that our construction budget is going to be representative of the work that we're going to do and the product that we're going to be putting on the market. And the product we're putting on the market has to match the comps that we're using for our resales. The next thing we want to look at is how recent are these sales? Is this something that sold last week, or is this something that sold 3 years ago? We're in a fluctuating market right now where interest rate changes can have a huge impact on the value of that house or the resale value. And so if we're anticipating prices to go down or up or sideways or whatever, we have to make sure that we're looking at the very most recent data that we can find. Last and not least, when we're estimating ARV, as we have this fluctuating market, if you can look at, if you identify two or three or four properties that are similar in size, similar in condition, to our finished product, similar in property type, and we get kind of an idea. All right, maybe that house is going to sell somewhere between 340 and 350, right? I might just go back here and I'm going to take maybe 5% off of that, right? Take 15,000 off. Base my budget on 320 or 325 or even 330 if you have to. But at the end of the day, we want to be conservative so that there's some buffer room in there if something were to change in the market. If you've ever seen an episode of one of those HGTV remodeling shows, you probably know what this second major area of bad math is going to be. Um, Overlooked expenses. You know, you can calculate your ARV right, and you can calculate your construction costs correctly, which we'll cover in a minute. But if you miss some of the transactional costs or the basic expenses of owning and, you know, holding on to that property, it's going to really eat into your bottom line. Most people overlook a lot of these. The first type of these expenses are going to be your transaction costs. They're simple stuff. Transfer taxes, the title company fees like insurance and recording and wire fees and that sort of thing. You've got lender fees. If you're using a lender, whether it's a bank or a hard money lender or a private lender, there's going to be costs associated with that loan, either in the origination phase or recording, uh, but there's going to be expenses. And then you've got realtor fees, commissions, processing, and some of these fees are on both the buy side and the sale side, like the transfer tax. Sometimes there's exit fees for a lender, but your commissions and processing fees for an agent, all that stuff adds up. Once you own the property, you've got some real holding costs. You've got interest expenses for your loan. You've got property insurance, right? That can be really expensive on a construction project. If you've got a builder's risk policy, that can add up to quite a bit of money. You've got, utilities, property taxes. All of these things are based on how long you hold the property. So there's a simple, easy fix here, and that is a spreadsheet. Now, you don't want to do this on every project or every project that you evaluate. But when you get serious enough that the numbers look pretty close and you want to really determine where your budget's going to be and what your profit's really going to look like, it's time to pull out a spreadsheet. It's time to break down all of these recurring expenses that you see in every project and then look at things that might not be there. Include real expenses to buy and sell the property. If you're not sure what those are, you can consult a realtor, a real estate agent who, oftentimes can put together an estimated cash to close, which will give you those transaction fees. But when you're talking about holding costs, if you're right now a renter and you've never owned a property before, well, maybe look at where your money is going in your apartment. If you own your own home, write down your utility costs, take a look at some of the expenses. Security might be an issue on a vacant property. You might want to include something like that. You might be looking at, basic utilities. You might be looking at gas or oil or electric, trash and sewer and all those kind of things. You're probably not looking at a satellite dish and cable or things like that, but there are things that are going to occur. Put them in a spreadsheet, do the calculation so that you know what those unexpected expenses are going to be, and make sure that you do not overlook them. Probably the most overlooked area of risk in any project is going to be the construction portion of this. And many times the risk starts with a miscalculation of those construction costs. When I first got into real estate, we used to calculate about $25,000 to go in and do a basic level rehab on a property: carpet, paint, kitchen, maybe a bathroom. And we're talking maybe a 1,000 to 1,200 square foot row home in Philadelphia. So, we're not talking about a 3,000 square foot, property in the suburbs, or even an 1,800 square foot detached property. But very quickly, I mean, and that was 20 years ago. Very quickly, those construction costs have changed, and very significantly. So, calculating the right construction cost for your project is super important. And a lot of that is going to start with getting a realistic timeline. A lot of newer investors have this unrealistic idea of how long it takes to remodel a bathroom, or how long it takes to put flooring down, paint the house, put on a roof, all of the things that might go into a renovation project. Now, if you're living in the house, it's probably going to take a lot longer to renovate than if the place is vacant. And I hope you're not living in an investment property. But you know, there are some problems that take time and don't really show much result. Rewiring a home or replumbing that house, it's not a very sexy thing to do, and it costs a lot of money. Um, but it's super important to do those things if the house needs it. So the first thing that you want to do is get a realistic expectation here. Second, you don't want to make your contractor a liar or a thief. I think there's a common misconception in the maybe not in the construction trades, but if you have never dealt with a contractor, a lot of times, especially in markets where contractors are competing for jobs, a lot of times they're going to underbid the job if you keep pushing and pushing and pushing for a lower price. Having a low price is important, and keeping to a budget's important, but you got to make sure your budget's realistic. Otherwise, you end up with the only guy that would take the job. He's the cheapest cost, and halfway through the project, he realizes he can't afford to finish it. So from there, he is either going to walk away, or he's going to be stealing from his next project, and that's not somebody that you want to deal with. So get several bids, and actually, we'll get into this in a second. And then contingencies. Contingencies. A lot of times people will overlook this. Things will go wrong with your renovation. They almost never come out exactly according to plan. So when they do, you got to make sure you have a budget and a plan. What happens if the contractor doesn't show up at the job site? What happens if there's additional work that needs to be done? What happens if the house has termite damage and you have to replace the whole back wall of the property? These are things that really happen. Another area that people overlook a lot of times are permits and inspections. This can be a really severe pain in the butt. In some municipalities, this can add weeks and weeks to a project. I know that sounds nuts, but look, you got to know going in what the rules and regulations are. Getting permits before the work starts may save you hours and hundreds or thousands of dollars in headaches and heartache throughout the project. So here's how you fix this. Here's how you make sure that your calculations are right. It all starts with determining what you need to do on the project, right? Create a detailed scope of work. This is often overlooked. You walk the job with one guy or maybe two contractors, and you're throwing out different things that you want to do in the house without a defined list. So start by creating a scope of work. You can walk through with your phone and just do a recording, and then go back through and make a list as as you're sitting at your desk. But you want something detailed, room by room, item by item. You want to, then take that and determine what kind of materials you're going to need. Your idea of a nice finished product and the contractor's idea of a nice finished product may be two vastly different things. It's important to set the expectation, number one, with the type of materials that you're going to be using, and number two, what the costs of those are going to be, and maybe even where you get them. So you can make a spreadsheet with a list of the materials that you're going to use in the bathroom. This tile goes on the floor. This tile goes in the surround. This is the tub that I'm using. Here's the diverter and the faucet and shower head. This is the vanity. This is the sink. This is the toilet. All those things. You make that list, and if this is your first time, just go to Home Depot. right? Start there at Home Depot or Lowe's or one of the big box stores. As your process develops on your second or third or fourth project, you can get a little bit more specific about the suppliers that you want to use and the costs, and and negotiating with those suppliers to get the best prices. But you have to start somewhere. Next, you want to get multiple bids. This sounds obvious, but hey, it's a lot of work up front to get that project ready to go. You got to make sure that your ducks are in a row and then bring in a couple different contractors. Maybe you want to use subcontractors, maybe you want a GC, maybe you want one or two guys doing the whole project. Whatever the case might be, you have to make sure that you're comparing apples to apples. Get a price for each item on the list. And I'm not talking about a $50, price point, but let's say we're going to remodel the bathroom. In a bathroom, we have the rough plumbing, we have the finished plumbing, we have tile work, we probably have drywall, we probably have, you're going to set all your fixtures. You got paint in there, you've got I don't know, did I mention tile? You got tile work, right? All of that stuff. You want to bid out each part of the project, and maybe one person can do the job. Maybe you need to bring in a couple different vendors or subcontractors to do the work. Take a look side by side at numbers and determine what fits your budget, and the contractor that you think is going to do the best job for the money that you're paying them. Include incentives and penalties on your contract. If you finish that, start date is Monday, January 15th, right? We are going to finish this job in 2 weeks. If you finish in 2 weeks, this is the price. If you finish in 10 days, there's an incentive of $50 or $100 a day in a bonus for each day that you finish early, right? And maybe there's also a penalty of $50 to $100 a day coming off the final payment for each day that they go over. These are just guides, but you want to create incentives for the type of behavior and the type of performance that you're looking for. Next, visit the municipal office and understand the local permit process and requirements. Some municipalities require you to get a permit to change a toilet in your own house. Others, not so much. They don't care. They just want to make sure that, they're just glad that you're doing work on that ugly house around the corner, right? Make sure that you know what the rules and the laws are. Make sure that you're putting in your applications for permits as necessary. Get the inspections. A lot of times the building inspectors can be your friends. If you're not sure what you're looking at, what the contractor is doing, get your plumbing inspections and electrical inspection and all the things that are being done throughout the process. If you start early and communicate with the people in the building department, a lot of times they will be your friends and can educate you as you go through the process. And then last but not least, prepare a project calendar. Schedule it out. Schedule with your vendors, schedule with your contractors. Make sure that the materials are delivered before they are needed on site. And sometimes that might be your delivery. But I'll tell you what, a lot of times you can have these materials delivered with a lot less hassle and a lot less frustration a day or two ahead of time, and then you're not spending 4 hours at Lowe's looking for a small bit of material. You take a couple steps ahead of time. You put in a few hours up front, and you'll have a plan to execute on this project. If this contractor bails, you already know what you're going to do. If somebody doesn't show up, if there's a contingency, or I'm sorry, if there's a problem on the renovation, you have a contingency, one, to pay for it, and two, to execute on it. By doing this, you can sidestep a lot of the problems that go on in a rehab project. Being a successful real estate investor comes down to mastering three basic skills: find the deals, find the contractors, find the money. Hard money can be a great tool to help you check that third box. But you might be asking yourself, Josh, how do I get approved? Luckily, we put together a free report so you'll know exactly how to get all the funding that you need. It's called 7 Steps to a Guaranteed Hard Money Loan Approval, and it's available right now. Go to hardmoneybankers.net / build/grow. That website again is hardmoneybankers.net / build/grow. Get all of the funding you need so you can build and grow your real estate portfolio. Investing legend Warren Buffett famously said, the first rule of an investment is don't lose money. And the second rule of an investment is don't forget the first rule. Every successful real estate investor knows that things don't always go as planned. Know the risks. Have a plan to minimize the impact, and you'll surprise yourself at how well you perform.